Getting conventional financing to purchase or refinance a condominium building has gotten harder in the last few months, thanks to some new guidelines which have been implemented by Fannie Mae and Freddie Mac. Hey guys, it's Evan Swanson here with Guild Mortgage, here with an important update to any of you who transact in the condominium market, because what we know is based on recent estimates, somewhere between 30 to 40% of all HOAs across the country are no longer eligible for conventional financing. And I want to walk you through some of those changes just so that you have a basic understanding of what we're dealing with. So a lot of this is in response to the tragic collapse of the Surfside condominium complex in Florida back in 2021. The reality is not only did the HOA neglect to maintain the property properly, but in addition, the property was severely underinsured. And where Fannie Mae and Freddie Mac are coming from is they simply want better consumer protection provisions to make sure that people who buy condominiums are protected from not only physical, but also financial harm. The timeline for this effect is these updates were actually published about a year ago in February of 2024. They went into effect in June of 2024, but lenders really started to implement them more seriously in October and November of last year. Now, the timing of these updates could really not come at a worse time as it pertains to property insurance, because as we know, given a lot of the climate disasters that have been extremely costly for insurers, residential insurance premiums have been increasing all over the country, including for condominiums. And what we're finding is a lot of HOA boards are figuring out a way to loosen their insurance coverage in order to make the premiums more affordable at the same time that these guidelines are requiring more significant coverage. Here's one thing I want to communicate is that previous sales inside a condominium development may not be an indicator of whether or not that property will be eligible for conventional financing, because these guidelines really started to be implemented around October of November of last year. So any condominium sale that happened prior to that time period may not have been put through the same level of scrutiny and therefore would not be found in underwriting. So what are the changes? Well, number one, Fannie and Freddie now require that the property coverage have mandatory replacement costs, and that replacement cost covers 100% of the reconstruction costs of that building. So no longer are alternative paths for coverage available, like actual cash value. Okay, so replacement cost guarantee is the only way to move forward, and the lender is required to document, typically from the insurance company, how that replacement cost coverage is calculated. Oftentimes that can be with a replacement cost estimator or some sort of estimate on construction. Now, in terms of the required perils, the actual perils that insurance or Fannie and Freddie require to have coverage haven't changed. These are all pretty standard. But what is different is these particular perils here are deemed to be non-geographic. Prior to these changes, it was possible if a specific peril had a deductible amount or coverage that was not up to Fannie Freddie requirements, the condo buyer could get HO6 policy or unit owner's policy to cure that difference, and we could make the financing work. But under this new provision, these perils, which are a majority of them, are now deemed to be non-geographic, and they have to meet the deductible requirements within the master policy. Speaking of which, Fannie and Freddie both define the maximum deductible for any one of these perils to be 5% of the replacement costs coverage, okay? And so what we're seeing here in the Pacific Northwest is oftentimes any of these HOAs that had damage last year due to the winter storm of frozen pipes and leaking, is they have increased the deductible on water damage, again, to reduce the premium cost. But that if that exceeds 5%, then that is no longer eligible for conventional financing, and we can't cure that through the HO6 policy. It's also required that master insurance policies carry inflation guard. This is a provision or endorsement to the insurance policy that guarantees inflation with regard to reconstruction costs down the road. Now, if inflation guard is not available in a specific market, we can get an email from the insurance company to verify that. Another one that's tripping up some transactions is a requirement for what's called the waiver of subrogation or waiver of rights of recovery. This governs how the master policy for the condominium unit and the unit owner's HO6 policy relate. So if there were damage inside of a condominium that caused damage not only to the condo, but also the interior or common elements that would hit the master policy insurance must waive their right to transfer any liability to the HO6 policy insurance company in the event that the unit owner caused the damage. And we are seeing that there are many master policies out there that do not have this provision, and again, therefore are not eligible for Fannie and Freddie financing. Now, what if a condominium development is not eligible for Fannie Freddie because of these insurance requirements? Well, theoretically, it is possible for the HOA to be notified, and it is possible for the HOA to try and resolve those issues with their insurance company during the escrow period. In practice, what it's our understanding is that it takes HOA boards and insurance companies a long time to modify coverage for master policy. So if that is the case, plan on extending timelines. Furthermore, the alternative lending programs would be FHA, VA, or non-QM lending. So believe it or not, with these changes, in many cases, FHA financing actually has lower requirements for master policy insurance than Fannie and Freddie do. So just because a condo is not eligible for Fannie or Freddie financing, it may still be eligible for FHA or VA financing. And then many non-qualified mortgage lenders out there, which often carry higher interest rates or higher costs, are willing to do these loans even if the insurance doesn't meet Fannie and Freddie requirements. Now, in talking to industry leaders and talking to local insurance companies, we expect over time that Fannie and Freddie may loosen the requirements a little bit or offer some sort of alternative path. And we also know that insurance companies are just being notified of these changes now, and we do expect some of them to modify or accommodate these changes in future insurance policy coverages. So if you have any questions about how these may impact your business, we would love to be a resource for you. Please holler out and contact us today. Thank you so much.